Hi everyone, I'm Rick, and in today's video we're gonna list the 5 best dividend ETFs that you need to own this year if you're looking for above average, stable dividend payments. I'm gonna go straight to the 5 ETFs, starting with the one with the highest trailing 12 months dividend yield. Alright, this ETF takes a 10% slice of an ideal dividend ETF portfolio and has a really high but stable trailing 12 months dividend yield of 4.52%. This means that a $265,000 portfolio today will yield you $1,000 per month of free, easy dividend passive income. And if you were expecting a higher dividend yield, like the 12% of JEPI, last week I published a video with an analysis on JEPI and I explained why you will not be able to deliver such a high yield in the future and will also probably underperform the market. You can check it out after this video if you want, and I'll link it in the description below. Now, our ETF belongs to one of the biggest investing companies, SPDR, and it's called SPDR Portfolio S&P 500 High Dividend Yield, ticker SPYD. What I like about this ETF is, of course, the high dividend yield. But more than that, the potential to pay them quite sustainably based on the way they pick their companies. This ETF picks the top 80 companies with the highest dividend yields in the S&P 500, so they're definitely safe and solid companies. They kind of overdid with the dividend yield in December of 2022 with a growth of almost 300% compared to the previous payment, and this has brought to a decline in March 2023. But in general, they always manage to constantly grow their dividend payments. The expense ratio on this ETF is 0.07%, namely you pay $7 yearly for a $10,000 portfolio. And with over $6 billion in assets under management, you can stay assured that this ETF is backed up by enough liquidity and trading volume. Another good part about this ETF, if you invest in it together with the others that I will mention later, is the sector allocation. In fact, real estate covers 21% of this portfolio, and considering that the other ETFs don't cover this sector so much, you open yourself to a sector which typically pays really good dividends and you diversify even more. Compared to a couple of months ago, one thing that I noticed is that they have strongly reduced exposure to the energy sector. And I believe this is a good thing because the energy sector has grown so much since 2020 that I can expect the prices or the growth at least to slow down in the future. Look for example at ExxonMobil. From 2020 to today, it grew roughly 300% in just 2 years. But it's not sustainable in my opinion, and you can expect it to slow down soon. Oh, and in case you haven't done a good deed today, guys, I'd love if you could support my channel with a beautiful like to this video. So thank you very much for taking the time. And if you're a long-term investor and you still haven't done it, I'd suggest you to open a Roth IRA account for your investments. You can do it with any brokerage account like M1 Finance, Webull, or Robinhood, and thanks to the Roth IRA, you're gonna get tax-free growth and tax-free withdrawals in retirement. But now, let's get to the number 4. Our dividend ETF number 4 takes 10% of the cake and is an iShares ETF. If you're unfamiliar with it, iShares is a collection of ETFs managed by BlackRock, which is the biggest financial management company dealing in ETFs, followed by Vanguard, State Street, Invesco, and Charles Schwab. The fund was created in June 2014, so we don't exactly have 10 years of track record, but if you invested $10,000 in this ETF 9 years ago, you now have $24,550, which would give you 2.39% of dividends according to last year, namely $587 per year. The ETF is called DGRO, the iShares Core Dividend Growth ETF. What I like about this ETF is the strategy they use. DGRO tracks the US Dividend Growth Index from Morningstar, which is a dividend dollar weighted index that seeks to measure the performance of US companies selected based on a consistent history of growing dividends. It has a high number of holdings, which gives us diversification and over 23 billion in assets under management. Another interesting aspect of this ETF is that it gives you exposure also to small and medium cap, whereas all the others that I will mention in this list focus on large cap. Besides this, another thing that I really like about this fund is how they pick the stocks. DGRO screens for 5 consecutive years of dividend growth to identify the dividend growers. It looks for paid out dividends not exceeding 75% of earnings, which narrows in on companies with some growth potential and that may continue growing dividends. One thing that I instead don't like about how they pick the stocks is that they cut out the top 10% of dividend yielding stocks. They do it to reduce exposure to companies with unsustainably high dividend yields, but the problem is that it takes away also great companies like Verizon or Altra or similar good companies. The expense ratio on this one is low at 0.08%, and since inception in 2014, it's given an annualized return of 10.71%, which is really not bad. Considering that year to date we're sitting at minus 3.98%, this might be a good entry point for long-term investors. The ETF number 3 is also an ETF from iShares and takes 20% of the cake. This ETF had the absolute highest 10 years total return right after SCHD among all existing dividend ETFs. So we're talking about a stable ETF that proved wonderful returns in the long term. Complete this beautiful picture with 3.59% dividend yield and you get it. The iShares Select Dividend ETF. If you invested $10,000 in this ETF 10 years ago, you now have $26,013, which gives you a growth of 10.03% per year. The total growth of 194% that I showed you before comes from Seeking Alpha and considers their investments of all the dividends. So how much are these dividends? 3.59% last year with an average of 3.50% in the last 4 years. So you'd need a portfolio of $334,000 to get $1,000 per month in clean, passive dividends. I know that over $300,000 sounds like a lot, but remember that we're talking about free money and that the ETFs that are able to give you stable dividends for a long period of time usually revolve around 3%. The fund has $22 billion in assets under management, an expense ratio of 0.38%, and gives you access to exactly 100 broad cap companies with a consistent history of dividends. If you know me and my channel, you know that I always suggest ETFs containing at least 100 companies, so we are right on the limit, but it's still acceptable for this ETF. The biggest exposure is to the utility sector with 28%, giving the fund a defensive character and stability in the dividend distribution. Utility is followed by financial and consumer staples, which again tend to be good dividend paying sectors. The second dividend ETF that every investor should have in their portfolio takes a 30% slice of the cake. And if you'd invested $10,000 10 years ago, you now have $26,298, and they would yield you today $818 yearly in free passive income, aka dividends. I'm talking about VYM, the Vanguard High Dividend Yield ETF. This fund tracks the performance of the FTSE High Dividend Yield Index, an index that selects high-yield, dividend-paying companies based in the US, excluding REITs. This fund is passively managed, which means super low fees of 0.06%, and it's highly diversified with 440 individual company stocks in the portfolio. The largest sectors are financials, healthcare, and consumer staples, which are typically stable sectors. And the top 10 companies within this fund have names like ExxonMobil, JP Morgan, Johnson & Johnson, Procter & Gamble, and Chevron Corporation. The investment style of this fund is large value, meaning it invests in large mature companies that usually pay good dividends and have stable financials. In the last 10 years, it's had an average appreciation of 10.15% per year, which is great, and has a dividend yield of 3.11%. Another interesting point for its stability is that it managed to go down only 1.81% year to date, showing stability in a declining market like this. So is Vanguard High Dividend Yield ETF a strong ETF right now? Well, it's clearly one of your best choices if you want to outperform the most stable, dividend-rich slice of the market, which is large value. And considering the high diversification and the stability it's shown in the past few years, you can be sure that this is an ETF that you should invest in for the long term. The first ETF is one of my favorites, and I'd give it 35% of the dividend ETF portfolio. If you'd invested $10,000 10 years ago, you'd now have $31,312, and they would yield you now $1,130 yearly only on dividends. I know $1,000 in a year might not sound much to some of you, but consider that dividends are only a part of the growth of this ETF. In fact, in the last 10 years, it grew exactly like the S&P 500 index. I'm talking about SCHD, the Schwab US Dividend Equity ETF. The best choice you have if you want to have a good stable growth, but also a nice dividend payout every year. SCHD yielded 3.61% and has held an average of 3% over the last 10 years. As for the total returns, in the last 10 years, SCHD delivered 12.09% per year, giving a total of 213% over the last 10 years. This equals the annual return of 12.22% of the S&P 500 over the same period. A key reason why SCHD performed like the S&P 500 in the long term is that the total return comes from capital gains and compound dividend reinvestments. So not only the market price increased by almost 10% per year, but reinvesting the 3% dividends on top of that, you get to the 12.73% per year we said before, which is abnormally high if you ask me for a dividend ETF. And if you're worried about the stability of the dividend yield, know that SCHD managed 10 consecutive years of dividend payment increases. SCHD has all the positive characteristics that you expect from an ETF. Long history of positive returns, low expense ratio, over 100 holdings, 47 billion in assets under management, a wonderful return on equity of 37.29%, and like icing on the cake, it doesn't just only grow, but it also delivers dividends, which is one of the best gifts for passive income lovers. The fund tracks the return of the Dow Jones US Dividend 100 Index, which in practice means companies with strong fundamentals that issue safe and high-quality dividends. You're gonna get a mix of companies such as AbbVie, PepsiCo, Cisco, UPS, Texas Instruments, Coca-Cola, and so on. All sectors are well covered, with a stronger weight on information technology and financials, which is a good thing considering that these sectors usually outperform in the long run. So should you own this ETF? I think every investor should. We're talking about a stable ETF with a great long track record that pays good dividends and delivers results which are just as good as the S&P 500. If you like dividends, this is your first choice. Of course, dividends are not everything. As an investor, except if you're over 50 or 60 years old, I believe you should focus more on capital appreciation. That's why you should check out this video where I illustrate the perfect ETF portfolio for 2023, and here I give you the best 8 ETFs to invest in, covering growth and value, US and international, and all the sectors. You're gonna see that if you want the best growth overall, the best ETFs you'll find are not necessarily ETFs that distribute dividends to you. If you want a free compound interest calculator, you can get mine for free through the link in the description below. And if you enjoyed this video, don't forget to subscribe to my channel and you'll get new interesting content on personal finance and investing every week. I wish you a great day, guys, or evening, and as always, I'll see you in the next video. Ciao!